In this video, traders, let's look at the trading strategy that's like walking through a minefield. Stay tuned. Hey guys, warm welcome to you. Thank you for joining me. All right, so this trading strategy is pretty much like walking through a minefield. In other words, you get away with it, 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 you think you're a genius, you think you know where all the mines are, all of a sudden you step on a mine and it's game over. It's not a case of it's going to hurt you a little bit, it's a case of it's the end of your trading account. It blows the legs off your trading account. So what is this strategy and kind of what's it all about? How does it work and why is it so dangerous? So this is kind of a strategy that a lot of these copy traders who are doing well for a short period of time employ, because on paper it looks like you're a trading genius, because basically what you're doing is you are adding to trades as they go against you. So if you've got very deep pockets or demo, then this will always work. In other words, if you have deep enough pockets, you are going to get 95%, 98, if not 100% of trades right over a kind of 6-month period with ease. Now, what you're doing here, what people are doing here is they're kind of buying and they're adding at another level, they're adding at another level, they're adding at another level, and they just basically will keep adding to the trade. So you can see that if you're trading this live, this gets uncomfortable pretty quick. But if you're trading it with very, very small size or a demo account and your objective is purely to get most profitable trades, this is going to work for you, because in the right conditions, the market will nearly always give you some kind of respite to come out. Example here, you're buying here, you then start to peel the trade off. As it comes back up, and you're either going to take the whole trade off, a slight profit. So if it came back up here, you've got profit on this, break even on this, loss of this. That's a profitable trade. Net, that's a profitable trade. If, for example, you bought, so let's clear those off. Let's say you made your first buy here and it came up, you take it off, you make a profitable trade. So regardless of how you traded this, you're always going to mark up a profitable trade. Now, that obviously the hidden issue we have with this is the risk that you're taking on. Now, if we scroll back on a 15-minute chart, by the way, in cable here, guys, if you scroll back and look, we can go back a long, long time, you are almost always getting an opportunity to make a profitable trade if you're adding. Now, some people mess this up, even this kind of dangerous strategy, because they add too soon. They add and add and add and add, and they're way too deep, and they don't get the rotations back that are deep enough for them to get out of the trade. Example would be here. Let's say they went short here, and they went short here again, they went short here again, they went short here again. Market's not come back enough yet. The break even's about here, so they're adding again, they're adding again. Now they've got 1, 2, 3, 4, 5, 6 positions. Market comes back, bang, they manage to get out. They get a profit on this, they get a profit on this, profit on this, break even this, loss, loss. That's a profitable trade. But hey, the unrealized or the maximum adverse excursion is full max loss here, full loss here. All these are losers, 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 and that's really making a horrible unrealized P&L. You can imagine that how bad that looks. But comes out, close it back here, ding, profitable trade. They mark it up as one profitable trade. That goes on the statistics as another profitable trade. And all they do is they continue in. And you can see this cable chart, guys, if you are adding to your position at sensible levels, but sensible in inverted commas, really, because there's nothing sensible about this strategy. We'll talk about the hidden dangers, which are obvious in a moment. But you're almost always going to get enough of a rotation back to take the trade off, even if you have to sit through it for a long period of time. And this is the kind of things with these copy traders, guys. And listen, there's loads of great copy traders out there. Some guys are doing a great job and they're sharing some of the things they're doing, and it's a good place to, I think, learn. It's a good place to utilize, a good service to utilize. I'm not against them. However, I've seen a lot of traders who are on top of the leaderboards, and when you dig in, they're doing this. They're adding, they're taking a little bit of advantage of the fact that the leaderboard promotes them for being 100% profitable. It promotes them for this, it promotes them for the others. And very often, guys, what's happening is they're in some of these trades that keep going. Imagine that keeps going, and they're waiting for it to come back, and they leave it in the unrealized section, and they go and start trading something else like euro, like yen, like Swissy, whatever, and they leave that and then hope it comes back. And a majority of the time it might well do so, and eventually then they chalk it up as a profitable trade. But while it's not a closed trade, it doesn't go on the books as an unprofitable trade. Now, obviously, you can see the problem we have is twofold. Number one is you are risking an awful lot. When you're in your worst possible trade, you're on the biggest possible size. And the risk is just completely messed up, because if you're taking a short here expecting for it to come down to here, you're taking whatever the position size is, it could be 1/10 of the position that goes against you when you're adding 10 times. So, if it goes your way, you go, great, I'm a genius, I've made 10 pips, 5 pips, whatever the trade may be. If it goes against you, this could be down 300 or 400 pips, and you've got more size on. This is down another 300, that's down 200, that's down 100. You get the idea. Before you know it, your cumulative R is maybe 1,000 pips loss. And so the order of magnitude just doesn't work. In the real world, if you did this, you could be sitting on an unrealized profit of 10 grand, whereas every so often you're taking $10 out of the trade. It doesn't work. And of course, the other issue we have, guys, which you can probably see straight away, those astute of you out there will spot straight away the danger of this is, hey, if the market just keeps going, and it keeps going, and it keeps going, and it keeps going, and it keeps going for multiple days. I'm on a 15-minute chart here, but imagine this. Let's zoom out on this. Let's imagine this kept going and going and going and going. That's the worst drawing ever, get the idea. And you're adding and adding and adding, and there's no respite. So in other words, no rotations back to be able to take into the trade off. You're in, 20 times, 30 times the size, and that's when blow-ups happen. Because obviously, if you're in real money, it's like going to a roulette table, isn't it? And constantly doubling up when you're a loser. You double up, you double up, you double up, you double up. The chance of being, 10 black or reds in a row are quite slim. But then once you have 10, the chance of being an 11th is still 50-50. So you're in this massive hole, you're doubling and doubling, and it gets big pretty quickly. Now, people generally won't double up on the position with this, but they'll add and add and add. And, it could be a very, very big position. And if you're in real money, you can't stomach this. You can't stomach any unusual moves because you're in the biggest position possible. And let's say then it suddenly does an exhaustion move, does another 300 pips over the next week. You're in a massive position. You're just not going to be able to cover that margin. It's not sensible either. But when you're trading a copy trader, you're on demo, it looks great. So it's like the walking through a minefield. And actually, you can get away with this for almost years. If the market's been rotational for years, let's stick it in a daily chart for cable here. If the market's been rotational for a long period of time, as long as you're spaced out enough, you're going to get away with it. But the danger is, of course, is the one time you're not, is the time that the whole game ends. So that's exactly like the analogy of walking through a minefield. You get away with it, you think you're great. 100% success rate. I've walked through this minefield, 50 times, and I've got through it 50 times. You just don't know the 51st time you're going to step on the landmine. So just be careful of that, guys, if you are using the copy trading thing, and just be careful if you are working at that kind of scenario. I'm not against adding in a structured manner, but I think if you're adding and adding and adding and adding and adding, it's very uncomfortable. You're going to at some point sit with a very, very uncomfortable unrealized loss. And the chance to blow up then are significant, and you might get a rotation back and get out of it, but it's not a sensible way to trade it. I think it's a very dangerous way to trade, so be very, very careful and avoid that if you can. All right, guys, take care. See you in the next one. Bye-bye.